talk about SPYT. This is a newer product now. So this is the Defiance S&P 500 Income Target ETF, and it says you're targeting 20% yield. So how does this compare to JEPY? And I believe you also have a NASDAQ and a Russell one also filed and will come. So let's just talk about SPYT, I guess, because it's already out.
Yep.
How do you compare SPYT to JEPY? What's the difference?
Got it. So there's two kind of major differences in the construction of the portfolio. By the way, both use the, I'll call it the 0 day to expiration, the one full 24-hour day of expiration trade. So we trade this one every day as well. It's a daily trading with the option position. So in this scenario, SPYT, it's designed to have exposure to the S&P, right? As the name says. Currently, we actually ironically hold IVV in the portfolio, not SPY, but that's okay. People are more familiar with what SPY is.
Same thing. VOO, IVV, SPY.
Yeah.
S&P
IVV
500.
is just a little cheaper, right? It costs a little less to hold that ETF, but they're all the S&P 500.
Yeah.
Yes. So we hold that, and then we sell not just a call, but a call spread. So why the call spread, right? And the answer is, we don't want to have that much of a cap on the upside. And so the difference between a short call and a short call spread is with a short call, you're completely capped, right? Like with JEPY, I can only make so much every day. You can have a really strong market day and you look and JEPY only makes 25, 30 bips, right? Whereas SPYT will capture more of the upside because once we've made our target income for the day, right? With 20% annualized is our income target. Once we've made that, we're ready to capture more of the upside. So we don't want to cap the upside. And so if you're less interested in the high yield and you still want higher than average yield, like still 20% is a nice ETF, right? But you're more about total return and more about growth, SPYT will be a better option for you if you're looking for more of a total return. So in your previous question you had before about, the Qs and QQQY, if actually you're looking for total return, when we launch QQQT or like this one, SPYT, those are designed to capture a lot more of the upside because we're not capped every day. We just have a little period of time between the strikes. So like what you've got on the screen here, we were short the 50-55s and we're long the 50-70s. So after the market goes up and beyond 50-70, and by the way, I'm looking at the market right now, which you have this pulled up today, we're at 51.31. So we had, I think that's where we are right now if we're looking at the same thing. So yep, there we go, 51.31. So the fund is now participating in growth from 50-70 up to 51.31. So we made a whole extra 1% versus being capped at 50-70. Right. So it's going to capture more of the upside. It's the beauty of a call spread instead of a call. So because we're defining our risk, I'm not always going for the most yield, like with JEPY or even the yield maxes. I'm always going for the most yield. Yield is the priority. Not the case here. Here it's a target, which is 20% defined here. In this case, I don't know exactly what we sold that spread for. It was like $6 or $7, right? We're going to make that. That is what drives the 20% yield, this 20% distribution. But then we want as much upside as we can get. And so we use that long call at that 50-70 level to capture more of the upside. So it's gonna capture more of the upside and is probably over time better meaning a higher total return capture than just the pure volatility play of a JEPY.
Of course, because the S&P 500 tends to go up over time. So basically, it's like there's less downside protection, less cushion than JEPY, but you have more upside potential.
That's right. That's right.
So and obviously that comes with less yield. And I see it today. Look on my phone. The SPY is up 1.3%. JPY seems to be capped out at 0.66% upside, right? It's capped. But SPYT is up 1.2%. So obviously there's less upside cap. And you're confirming this is on a daily basis as well.
We trade these daily. Yes.
Okay, that's pretty interesting. That's what I didn't know about it. I thought spreads where maybe you're doing it weekly. So you're doing a daily option spread, and then you're holding IVV for your S&P 500 exposure, which is obviously the biggest chunk of the fund. And then if you have any cash, it's going in the short-term government treasuries.
That's right. And I would say there is one little advantage here of holding the IVV, right? I don't have to distribute the growth. So I can get NAV appreciation because I'm holding IVV, right? So what happens with an ETF, I think you know this, when you have profits from selling, buying and selling positions, you have to distribute 90% of the gains. Well, if I
Yeah.
hold IVV forever, right, I'm going to grow along with IVV, right? And so I'll get the dividend. Yes, sometimes I won't get all of the upside of IVV because I've got that cap, but on an up day, but on a down day, I'm earning the option income from the call spread. So it's a really interesting dynamic. So you could see NAV appreciation with SPYT because we're going to hold our long position and not sell it and not have to distribute it. And we're just going to distribute what we make selling that call spread each and every day.
Okay, so if you like the S&P 500, but you're not a super bull, you're cautiously optimistic, you go with a SPYT. If you're a little bit more pessimistic than that, then JEPY because you're getting more premium, because you're giving up more upside for more premium. It's not rocket science, right? Eternal super big bull optimist, you might as well get the index fund. And then there's layers of, the global X1, XYLD being the most pessimistic because they're giving up everything. So it's kind of like a range. And I think SPYT is more in the optimistic or more optimistic than JPY. And I'm assuming when the NASDAQ, do I have that right or am I crazy?
You're not crazy. I would say there's even I'm hesitating before I'm saying it. What I can from the history and the research we've done on this,
Yeah,
there's actually a chance, and some years the build that we're using for SPYT
yeah.
outperforms SPY, even in up years on SPY. So that 20% and the compounding and the reinvesting causes you to kind of build along the way. It's actually an interesting dynamic. And so you're right about, hey, look, if you're bullish, SPYT is the choice over JEPY. But JEPY, you still don't want to be bearish, right? Then you shouldn't be in that one at all if
Yeah.
you don't want to be
So
bearish,
what
right?
would cause SPY-T to outperform IVV over time if it goes up really slowly?
Yes, right. So, in a choppy year, because
Yes.
we're able to capture a 20% of option premium and reinvesting that can cause then, as the market then goes higher, you've got a bigger base to go up from then where you were if you were just holding the IVV itself,
Okay.
right?
So
So there's some dynamics that can work. And look, sometimes markets are flat and sideways, and in those years, SPY-T is a good thing to have kind of compounding and growing on your
okay.
share.
Yeah, it kind of reminds me like a SPY. I know you know what SPY is. I know you know the guys there. That's what they do. They don't hold IVV. They actually buy all the stocks in the S&P 500, and then they do a spread, an option spread. So is it kind of similar, except I don't know if they're doing it. I don't think they're doing it daily.
Yeah, I don't believe they're doing daily, right? I think they'll probably give up a little more on the upside because of it. And by the way, I think as SPY-T gets larger, there's probably a chance we move to holding the individual components as well,
Okay.
right? Even cutting a few more basis points, right? I think IVV's got 3 bips of cost in it. That's an extra cost we pay for, in our fund versus holding that. But at the right size, that 3 bips is worth it, to then do it by yourself, right, and build the portfolio. But then when it comes to, SPYI, let's take a look at their holdings real quick, right? So if you want to flip over to that,
Yeah, they
um,
have. Yeah.
yeah, I was wondering, they used to isolate their option positions to kind of see what their tactic looks like there. I thought that used to get called that. You could, yeah, if you download the spreadsheet, you'll see it. But again, I think they're more in the monthly camp than the daily
Yeah, the
camp,
monthly.
right?
Yeah.
And so, that'll just have a little different dynamics. Like there's times where that will work better. Our research says dailies work better, more often.
Yeah. I'll have to go through probably at the end.
Yeah, we've been able to
Um,
see that sheet and take a look at it.
let's see here. There's just cash, and other. You have all the stocks here. I guess we got to find where the. Okay, here they are. It should be these guys, right?
Yeah, you're not sharing that sheet.
Oh, I'm sorry.
That's okay.
Let me share. Here we go. Here is the Neos Holdings.
Here
I
we go.
believe it's these two here, which they conveniently put in red here.
Yeah, now those are both short, right? You see the negative 950
Yeah.
contracts, right? I don't know if they have a long side if they're actually doing a spread. They're probably just, using the mix to kind of get a targeted return on what they're selling. But
Okay.
so they may be capped as well, like the other covered call strategies. So the SPY-T using a call spread and out capturing capturing the upside is good. What does your phone tell you SPY-I is capturing today?
Yeah. Let's see. So SPY-I is up 91 basis points, so it's capturing less than SPY-T right now.
Yeah. So I think that's, maybe a little bit of that means they're still selling, calls at a good level, and, wherever that was, right? Again, the monthly, we'll see how far the market goes over the month. But yeah, again, there's all these different approaches, right? What is important to me, and I think about this, and compliments to all our competitors, like coming out with products like this that are designed around selling options as kind of the main differentiating piece, to me is what's really exciting, right? That's great. Every tactic is going to have a little different time where one works better than the other, but this is all good stuff, right? It all just confirms what we know, that adding option income to a portfolio is important, right? And it helps drive things like dividends.
Yeah. Yeah. And just a quick note, this has a 5 basis points less in fee than JEPY. I just want to point that out, 94 basis points. This includes the 3 bips of IBV.
Yep.
So if you ever take it out down the line, it'll, I'm assuming, go to 91.
Yeah, maybe even less, because I think that's kind of a blend, because we had SPY that was higher, now we're IVV, right? So
Okay.
it may come down even more. But yep, and look, that's the cost of doing daily, right? I mean,
Yeah. Yeah, of
someone's
course,
clicking
it's going to
buttons
be.
every day.
Okay. My final
Yeah.
question before I get into, I mean, I think we've been talking almost an hour here.
Wow.
I've been hearing questions along the lines of, look, there's so many of these options covered call, there's a million of them coming out. They're all growing. Is the options market going to get screwed up because of this? I know we had talked about, I think we talked about this offline, and I believe you told me something like, look, if you look at JEPI and JEPQ, which have like now combined over 40 billion, they barely make a dent in the index options market. Can you just confirm that? Let's just say these are getting bigger and bigger and bigger. Can they cause problems with the strategies in terms of options?
Not the index options at all, right?
Okay,
Like there really is, no
massive.
limit on that. It's the liquidity is there. There's more liquidity that could show up tomorrow. And I would say that's evidenced by the fact that as soon as we went, to 0 day options on the 3 main indexes, by the way, we're going to take a little credit for Russell going to every day. We asked them to do that for us for our IWMY product, Defiance product. But when you look at that, they absorbed all of that extra volume and you saw no blips. I think that there is plenty of liquidity here. There's probably, I don't know of any single product that could break the S&P 500 market. Like even all of these together, like you said, there's 40 billion between those two funds you mentioned alone. We're, add up all the newly launched covered call strategies. I don't even know if we're at 2 billion in those, right? So there's a lot more growth to go. And you're right, you don't even see a blip when the big boys do their trades and do their rolls. I don't think it'll be a problem. I really think we have plenty of liquidity in the market, and it's only growing.
Hopefully that comforts people who have that question. Last but not least, Jay, I know you're busy. I made a video recently about this announcement. We talked about this before, asked you about this before. My personal favorite product is covered calls with a little bit of leverage. Are very popular in Canada. They typically do 25% leverage. This seems to me like the first ever products from a company called Direction, which have a lot of like daily 2x, 3x bull and bear ETFs on the S&P 500, et cetera, et cetera. But I did a little bit of digging. First of all, they're going to do 50% leverage or 1.5 times leverage on JEPI and JEPQ, which are, S&P 500, NASDAQ, really, really, really big, popular covered call ETFs on the US side. And it's not 2x or 3x like some of their other products. It's 1.5, and it's not daily, it's a monthly. That's what I checked out on their prospectus. I actually read
Yep.
it. What do you think about this? Do you think this is going to be the trigger for maybe a leveraged YMAX, a leveraged SPYT, something like that would be absolutely incredible. I would love that, or a leveraged JPY, QQQY. Do you think it's coming? Are you guys thinking about this? Are you getting requests for this? My audience are certainly very interested. Your thoughts, comments?
Okay, so this is your zinger question for me. I got it. Okay, so let's. We haven't filed for anything with leverage. It's certainly something that has come up from time to time. My concern always with leverage is the legitimate NAV decay and compounding problem that you have. And so if you were to look, my concern with, by the way, Direction, it was a groundbreaking firm in the early 2000s with their leverage products. I remember trading them when I worked at TD Ameritrade, right? It was just, they were great. They're absolutely a name in the space when it comes to leverage, and they know what they're doing. They've been through the ups and downs of that business. But the ups and downs of leverage, as you know, is the compounding problem. And so if you think today you've got, the optics of NAV decay, where you're limiting your upside and you participate in all the downside, the math of that has never seemed favorable to me, right? So if I have 100% of the downside on a 1.5x, and I'm limiting my upside. And the way that JEPI does it, it's right at the money calls that they sell, right? They don't even give you an upside. I worry that you've got a vehicle that's got even more tendency to go down, and it's leveraged, right? So I have expressed that to my partners, and we've all kind of talked through that. Is it worth doing a leverage or not on these? I think that you will increase your yield. Got it. Of course,
Increase
it
your
will.
yield, increase your risk. But
Increase your yield,
if you're
increase your risk.
putting, yeah, I mean, the way I see it is, let's say you're putting 25% leverage, 50% leverage on JEPY or a JEPQ, which have a positive return. And let's say you're leveraging the monthly dividends, you're dripping everything. Wouldn't that just increase the performance over time? I mean, Direction has a 203 and a 300% daily leverage S&P 500, and the total returns are off the charts compared to just the SPY. So in my opinion, I see it as a positive, because as long as JEPI and JEPQ have positive returns, which of course they do, positive total returns, you'll just amplify those if you're holding it long term. With a lot of volatility as you month to month as you get there. So
Yeah, and I think that's the key, right? Understanding what, like, you get it and you understand it. And I would say you're completely fine investing in those. I worry about the average investor who goes, wow, in a down year when the market was down 25% or something,
yeah,
why am I compound? And it's like, it's volatility can be tough to overcome. And so I think as long as you know what to expect there, like any investment, just know what to expect and know what your play is going to be when different market environments come out, right? It's not something I would probably, as an advisor, put a lot of target-based investors into, but people that want alpha, that's what these vehicles are there for. So I understand, as long as they're used for the right place.
yeah, yeah. Well, Jay, listen, it's been an hour. You've been great. You answered all the questions. I hope you come back soon, and we're definitely going to take a look at all the new Defiance and Yield Max products that are coming out. I absolutely love these. I can't wait to add YMAX in my portfolio eventually. Maybe one day a slightly leveraged YMAX, wink, wink, right? So,
I
uh,
always
so
appreciate that you keep asking. Thanks, Adrian.
yeah, yeah. Oh, I will keep asking every time, because you said, if we get more and more requests, we'll consider it. So sure, on behalf of all my members and watchers, for sure, it's definitely it's my personal favorite product. I mean, in Canada, they're fairly popular. They actually borrow the money. It's classic leverage, and they're typically only 25%, so 1.25x. Whereas this one is 1.5, which I'm okay with 1.5 personally. I think like 200, we're starting to go a bit nuts, but the S&P 500 ones have been out for 10, 14 years, and they all have positive returns. Of course, a massive volatility when, on either side. So thanks again, Jay. I don't know if there's anything else you want to add, but I'm good. I'm pretty much done with the
No,
question.
thanks again for having me. Always a pleasure. Enjoy our conversations.
All right. See you soon, my friend.
You got it.